Across 5 different regions, local governments quietly strip as much as $4,000 or more from older homeowners' equity every year. And in most situations, nobody realizes what is happening until a bill lands in the mailbox, or the ownership records have already been completely transferred. This is not an ordinary tax. It is something else. It is a hidden transfer of ownership that has operated in these places for generations without interruption. And a 2023 Supreme Court ruling shut down only a portion of the practice. Everything else still continues today in every county inside those 5 states, and in 2 of them, the situation is projected to get worse. This year, you may have spent 30 or 40 years paying for your house. The deed lists your name. Your mortgage is gone. You assume the equity in that home belongs to you. But the rule that decides whether that equity actually remains yours is not found anywhere in federal statute. It is written county by county inside dense state tax codes drafted long before most of you were even born, or before any of this was widely recorded. And in the 5 states I am about to walk through, those laws still allow government departments or private buyers working through public channels to walk away with tens of thousands of dollars in equity that you spent your working life building. There is one document you can file at a county or city office that costs under $75 in most places and quietly blocks the harshest part of this system in 4 of the 5 states I will cover. I will show you what that filing is before we finish, but only after you see which states still operate under these rules and why older homeowners with paid-off houses face the greatest danger. The rule does not target people who are broke. It targets properties holding the most equity. That means seniors who followed every financial principle correctly often stand directly in front of the largest potential equity losses. Let us start with the legal case that exposed how the entire framework operated. A 94-year-old widow named Geraldine Tyler owned a small condo in Hennepin County, Minnesota. She eventually fell behind on her property tax payments. The total she owed, after late fees and interest, came to about $15,000. Hennepin County took her condo, sold it for $40,000, kept all of it, and gave absolutely nothing back to Geraldine Tyler. No reimbursement, no partial payment, no leftover balance. The county kept $25,000 of her home equity. Equity she had accumulated over many years, and the county announced that it was completely legal under Minnesota law. For years, courts in Minnesota and several other states said this approach was perfectly fine. Their reasoning was that once taxes went unpaid, the owner forfeited the entire property, not just the overdue tax amount. So if your home was worth $400,000 and you owed $10,000 in back taxes, the government could take the whole property and keep all $390,000 in equity. So Geraldine Tyler took the county to court. In May 2023, the United States Supreme Court ruled unanimously in Tyler v. Hennepin County that this practice violated the Takings Clause of the Fifth Amendment. The Constitution says the government cannot take private property for public use without providing fair payment. Grabbing $25,000 in equity to cover a $15,000 tax bill is, put simply, theft. But this is the point where most people stop paying attention to the story and never see the rest. The Supreme Court did not stop property tax foreclosure itself. It ruled only that any surplus equity above the tax bill must be returned to the owner. So seizure is still allowed. Auctions can still go forward. The home can still be lost. The only new requirement is that the county must issue a check for whatever money remains after the sale. And this is exactly where the next problem starts. In Minnesota and the 4 other states I will cover, the rules for how surplus amounts are calculated, how people are notified, what the deadlines are, and which costs can be deducted are still changing. Some counties subtract administrative expenses of 15 to 25% before sending surplus money. Others make owners file a separate court case just to access their funds. And if an older homeowner misses the claim window, sometimes as short as 90 days, the surplus can legally flow back to the county. So the federal decision ended the most extreme kind of equity grab. It did not stop equity from slowly disappearing. Losing $4,000 through fees, missed dates, and confusing rules remains common in tax sales across these 5 states. Even after Tyler, Minnesota updated its tax forfeiture law in 2024 to comply with federal standards. Surplus sale money is now placed into a state account, and former owners can submit claims during a set period. But there is no automatic claim form. The county must mail a notice, yet it sends that notice to the address on file, which, for estates in probate or seniors who have moved into care facilities, is often no longer accurate. So letters go out, timelines run out, and the leftover money stays with the state. This same pattern repeats across all 5 states in this video. The Supreme Court closed the main door. State legislators quietly left a side door open, and the people walking through that side door are usually investors who already know these procedures. Rarely is it the senior whose equity sits unclaimed in an account. One short phone call to your county auditor to ask whether your name appears on any surplus list from tax sales during the last 2 years will resolve this issue in Minnesota. Yet this is the exact type of call almost no one makes, because almost no one realizes they should. Now shift from Minnesota to Nebraska, which had one of the strictest equity removal systems in the country before Tyler. Nebraska used a tax certificate sale process where private investors buy a tax lien, hold it for 3 years, and then ask for a tax deed that transfers complete ownership to the investor. The original owner can reclaim the property during that 3-year window by paying the back taxes plus interest set at 14% by statute. So a $3,000 tax bill could grow to more than $4,500 before the right to redeem runs out. In one widely reported case from the late 2010s, a Nebraska homeowner lost a property worth about $200,000 over unpaid taxes of less than $6,000. The investor kept the entire equity. The homeowner got nothing. After Tyler, Nebraska changed the rules to require that leftover equity be paid back, but the certificate sale structure itself is still in place. Investors still buy tax certificates and still earn legally guaranteed interest. The older homeowner still faces a redemption clock starting as soon as payments fall behind. The only change is that if the owner does not redeem and the deed transfers, the investor must now pass any surplus proceeds back to the prior owner. However, figuring out that surplus triggers the familiar $4,000 cut. Nebraska law often lets counties and certificate holders deduct so-called recoverable costs from the surplus before it goes out. These can include attorney fees, title work, filing charges, and interest added during the redemption period. In many Nebraska counties, these subtractions run from about $3,500 to $4,500 per case. So, a senior expecting $20,000 in surplus equity may only see $16,000 or even less once those items are removed. Technically, this is not considered theft. The Tyler case allows reasonable administrative charges. Still, for an older person on a fixed check, losing $4,000 to procedural costs can be the deciding factor between staying in home care or being forced into a nursing facility. So the main protection in Nebraska is practical rather than purely legal. State law says certificate owners must send notices at various stages. Yet those documents are often written in heavy legal language that many seniors cannot easily understand. They look like junk mail or sales pitches. They get thrown away. The redemption deadline passes. Ownership changes hands. A Nebraska real estate lawyer, charging around $250 to $350 an hour, can look at those letters and explain where you stand in about 15 minutes. That $50 to $90 conversation can prevent a $4,000 haircut on surplus proceeds and sometimes prevent losing all equity at all if there is still time left to redeem. Nebraska also offers a homestead exemption form that, for homeowners 65 or older with modest income, reduces the taxable value of their property, or in some counties allows taxes to be postponed until the home is sold or transferred. The postponed amount becomes a lien on the property, but that lien is secondary to a first mortgage and grows at an interest rate far below the penalty rate charged on delinquent taxes. So older homeowners struggling with property taxes can ask for deferral, avoid tax certificate sales entirely, and protect their equity. The homestead paperwork goes to the county assessor, usually costs nothing, and can often be finished in a single visit. Yet few eligible Nebraska seniors ever file it, because almost no one talks to them about it. Adult children often do not know it exists. Many tax preparers skip over it. County assessors know about it but are not required to promote it. As a result, applications go unused while certificate sales continue across the state. Now, head east to New Jersey, where the process looks different but the possible equity damage is even greater. New Jersey regularly ranks near the top for effective property tax rates in the nation. In counties like Bergen, Essex, and Union, the typical homeowner pays between $12,000 and $18,000 per year in taxes on a single-family home. For seniors who paid off their mortgages decades ago, that line item often becomes their largest expense in retirement, sometimes bigger than medical costs. That is the starting point. Now look at what happens when an older homeowner in one of those counties falls behind. New Jersey runs a tax lien sale somewhat similar to Nebraska's model, but with one crucial twist. Interest on delinquent liens can go up to 18%, plus an additional 6% penalty on the original tax bill, so a $5,000 tax gap can turn into more than $6,500 in a year and top $10,000 in 3 years. But the bigger danger comes from something called the abandonment doctrine. Under New Jersey law, if a town labels a property as abandoned, the lien holder can push an accelerated foreclosure that shrinks the redemption window from 2 years down to as little as 45 days. The definition of abandoned is broad. A senior who moves temporarily into assisted living while relatives decide whether to sell can leave a house empty for 90 days and have it tagged as abandoned, triggering a fast-track foreclosure. In many New Jersey tax foreclosures involving paid-off senior homes, leftover equity after a Tyler-compliant sale commonly falls between $20,000 and $50,000. But state law permits deductions that include attorney fees, which, in accelerated cases, often total $3,000 to $4,000, plus lien interest, penalties, and local administrative charges. That $4,000 slice of equity in New Jersey is almost impossible to avoid, so the only real way to protect yourself there is to act before there is a problem. New Jersey runs a program called the Senior Freeze, previously the Property Tax Reimbursement Program, for owners 65 or older whose household income stays below a yearly threshold set by the Division of Taxation. The Senior Freeze does not erase taxes. It locks your effective tax bill at the amount you paid during your first qualifying year, and the state pays back any increases afterward. So if your tax bill goes from $12,000 to $15,000 over 5 years, the state reimburses the $3,000 difference each year. Applications go to the New Jersey Division of Taxation and do not require any payment. The catch is that you must reapply every year. Skip 1 year, and your frozen base amount jumps to the new, higher bill. So a senior who qualified at $12,000 and forgets to file 3 years later might restart at a base that is $2,000 higher. There is another issue. The state sends the reimbursement, not the town. The municipality still charges the full amount every year. Seniors must pay up front and then wait for the state to return the difference. For those on fixed incomes without enough cash to front the entire bill, the program becomes tough to use in practice. So the bill mounts, payments fall behind, and tax line sales eventually begin. A New Jersey elder law lawyer charging around $300 to $450 per hour can look at a senior's tax records and check Senior Freeze eligibility in one meeting. The fee often equals roughly 1 year of reimbursement, which makes the financial math straightforward. Now travel west to Illinois, which, before Tyler, had one of the most aggressive tax-related equity removal systems in the country. Illinois used a combined certificate and deed sale method, where investors could buy tax certificates, stack up extremely high interest rates in some counties, and then turn those certificates into full ownership when the redemption period ended. Cook County, which includes Chicago and holds most of Illinois' property value, became the center of these cases. In many documented examples, Illinois homeowners lost houses worth between $150,000 and $400,000 over unpaid tax amounts as low as $4,000. Investors walked away with the whole property value. The owners got zero. After Tyler, Illinois updated its tax law to require paying back surplus proceeds. But homeowner advocates argue the fixes do not go far enough. Illinois statutes commonly allow certificate buyers to take out their collection costs, legal charges, and statutory interest before handing over surplus equity. In Cook County, typical deductions after Tyler now fall between $3,800 and $5,200. So, a senior owed $30,000 might receive only around $25,000 when all deductions are finished. That is the real-world $4,000 equity loss. So the main protective document in Illinois is the Senior Citizens Homestead Exemption, designed for owners 65 or older who live in the home as their primary residence. This exemption reduces the equalized assessed value of the home by a set amount that differs between Cook County and other counties. The savings depend on the local tax rate, but usually add up to $400 to $700 per year. An even stronger tool is the Senior Citizens Real Estate Tax Deferral Program. Under that plan, Illinois homeowners over 65 who fall under income limits can postpone paying property taxes altogether. The unpaid balance becomes a lien with low simple interest and is settled when the property is transferred or sold. That lien comes after any main mortgage but before unsecured debts. So seniors do not fall delinquent, do not get pushed into tax sales, and do not lose $4,000 to surplus deductions. Applications usually go through county treasurers at the start of the year. There is usually no fee, but not many seniors use it because many worry that a tax lion will burden their children or heirs. In reality, a lien at a single-digit interest rate is far cheaper than delinquent penalty rates. The lien clears easily at sale or inheritance without hidden charges. So, deferral shields retirees and prevents forced auctions that can affect families later. There is another Illinois factor to consider. Cook County offers a disabled veterans standard homestead exemption that can substantially cut taxable value for veterans with qualifying service-connected disabilities. This benefit can pass to surviving spouses, but only if they file renewal documents each year with the county assessor. Those renewal forms get mailed to the address on file. So the same address problem appearing in Minnesota shows up again. Seniors who move into care facilities may miss the mail and lose exemptions worth thousands per year. An Illinois elder law or property tax lawyer can look at eligibility for every available program in one session. The fee for that visit is often recovered within the first year through properly set exemptions and deferrals. Now move east one last time to Massachusetts. Massachusetts is the most active example in this group because the debates over property tax and equity are still underway right now. The state has long had a tax limitation rule called Proposition 212 that caps yearly tax increases at 2.5% plus additional revenue from new construction. For many years, this protected owners from steep assessment hikes. But lately, a number of cities and towns have used overrides that allow voters to approve taxes above the cap for certain projects like schools, public safety buildings, or infrastructure upgrades. Many of these override votes have passed by simple majorities. This trend drew national focus because overrides often lead directly to higher tax bills. For seniors on fixed incomes in communities that approve overrides, annual property taxes can increase by $1,000 to $4,000. So here, equity is not disappearing through a seizure forbidden by Tyler, but through slowly rising tax obligations decided by local majorities. A second issue is forming. Some towns have begun discussing ideas that are informally called unrealized equity taxes, which would add charges based on how much a property has gained in value over the original purchase price. These proposals resemble similar conversations at the national level. None had become law by early 2026. Still, they are being debated in town meetings and legislative groups watched carefully by homeowner organizations. If one town adopts such a plan, it could set a pattern that spreads. A senior who bought a home decades ago for $150,000 that is now worth $700,000 could face a tax on $550,000 of unrealized gain. Even a 1% annual charge would create a $5,500 bill in cash without the owner ever touching that equity. So the main protection in Massachusetts is the Senior Circuit Breaker Tax Credit, available to owners 65 or older whose property tax bill is higher than a certain share of their yearly income. The credit limit is updated each year and is claimed on the Massachusetts state income tax return. There is no filing charge. The credit is refundable, meaning that even if a senior owes no state income tax, they still receive a payment. Another crucial filing is the local property tax exemption known as Clause 41, offered in most Massachusetts communities. The amounts differ from place to place, usually from a few hundred to several $1,000s per year, and applications go annually to local assessing boards, typically with no fee. Using both the circuit breaker credit and the Clause 41 exemption together can cut between $2,500 and $4,400 from yearly property tax costs. Now, I owe you the answer I promised earlier. There is one document you can file at your county or town hall that costs under $75 in most places and quietly blocks the harshest equity stripping systems in 4 of the 5 states we have discussed. That document is a homestead declaration. In Massachusetts, it is called a declaration of homestead. In Illinois, it appears as the Senior Citizens Homestead Exemption. In Minnesota, it is known as the Homestead Classification. In Nebraska, it is called the Homestead Exemption. New Jersey is the only one of the 5 without a comparable broad homestead safeguard written into law. A homestead declaration is a simple county-level filing that labels a property as your main residence and shields a portion of your equity from creditors and forced sales. In Massachusetts, that protection often covers hundreds of thousands of dollars. In Minnesota, it extends over large amounts of equity for primary homes on modest lots. Filing fees usually fall between $35 and $75 depending on the county. Here are 5 steps you should take this week before any of these systems reach you. First, find out if your state is one of the ones on this list. If you live in Minnesota, Nebraska, New Jersey, Illinois, or Massachusetts, you face the highest level of risk. Many other states offer similar tools under different names, with senior homestead exemptions usually being the first place to look. A real estate lawyer or county assessor can confirm whether you qualify in about 15 minutes. Second, file the homestead declaration with your county or town if you live in one of the 4 states where it applies. This single filing offers the most protection per dollar spent and usually costs under $75. Once recorded, it normally stays in force as long as you own the home and often extends to a surviving spouse. Third, ask your county assessor for your latest property tax assessment. Compare that assessed value against recent sales of similar homes nearby. If the assessment is higher than market value, submit a request for an abatement. That filing is usually free, and successful challenges often cut yearly tax bills by $400 to $1,200. Fourth, check if your state provides senior property tax deferral options. Illinois, Nebraska, and several other states allow owners over 65 to postpone paying property taxes and convert them into low-interest liens that are paid when the home is sold or passed on. This lets retirees stay protected during their later years and avoids forced sale situations that could impact heirs. Fifth, arrange a meeting with a licensed elder law or real estate attorney in your state. Typical hourly fees run from $250 to $450. During one session, you can cover homestead filings, deferral programs, surplus claim steps from earlier tax sales, and family transfer planning to safeguard equity if you become incapacitated. In many cases, the money protected or recovered during the first year exceeds the cost of that meeting. The core pattern in all 5 states is the same. Equity is not lost in a single obvious moment, but through steady leaks caused by charges, legal deductions, and missed paperwork. So real protection requires several small filings, each often under $100, that together guard the $4,000 or more that might otherwise silently disappear through these procedural systems.